There's the closing bell on Wall Street, and now it's market domination overtime. Let's get a check on where the major averages have ended the session. Right at the end here, the Dow going into the red. As we've been talking about, really a lot of volatility continuing throughout the day. Even when the Dow was higher, a lot of back and forth here. So finishing the day lower by about 83 points when all was said and done, almost a fifth of 1%. We did, of course, get CPI this morning, the Consumer Price Index, coming in a little bit milder than had been anticipated. And that was initially the impetus for the rally today, as there's been a lot of concern about growth at the same time that there was concern about high or even re-accelerating inflation. That latter part of the bogey seems to be not in play for the moment, but of course it could be affected by tariffs and the data going forward. Let's take a look at the S&P 500, finishing the day still higher by about 0.5%, but off the highs of the session and definitely lower than where it was out of the gate this morning, when we saw stocks starting strong and sort of fading as the day went on. Even for the NASDAQ, which was up 1.25%, similar situation here. We saw that little pop out of the gate and then a little bit of a fade as the day went on. And you can see how the S&P 500 was pulled up by looking at the equal weight, which was lower. So this implies that it was large cap tech that was responsible for the gains today. Of course, another way that we can look at that is to look at the action in the NASDAQ 100, where we saw a lot of strength in large cap tech. As we talked about earlier, Apple, the outlier here, but otherwise a lot of green, in particular NVIDIA seeing a boost today. There was a report that Intel was in talks with TSMC, and TSMC had sort of gathered almost a consortium of chip makers, including NVIDIA, AMD, and Broadcom, potentially to partner with TSMC to take over some of the Intel facilities here in the United States. So that was interesting. Broadcom itself up about 2% as well today. Tesla recovering for the second day in a row. The company's two-day gains now amounting to just about 12%, even as we talked about the drumbeat of negative analyst commentary has continued, but that hasn't stopped the rebound. Of course, the rebound looks a lot less when you still look at it on the year-to-date basis, when we see it down by 39%. So seeing the strength there in some of the largest of large caps, and then sector-wise, a little bit more divided, which again, you sort of know from looking at that equal weight index that was down. So consumer staples, healthcare, materials, real estate, utilities, all in the red here, but you did see consumer discretionary and tech sort of help save the day on the index level. Josh?
All right, Julie. Investors breathing a sigh of relief today as we're seeing smaller market moves to close out the session. The major averages finishing the day mixed, with tech stocks outperforming. Joining us now is Gargi Chaudhuri, BlackRock Chief Investment and Portfolio Strategist of America. Gargi, good to see you.
Hi, it's great to be here.
So plenty of worries for investors right now. You get Trump tariffs and government firings, and folks are wondering, could the economy slow? Maybe we'll even tilt into a recession. We've seen this sell-off, but you're telling your clients, you know what, you need to stay overweight U.S. equities here. How come?
Yeah, so we are talking about staying overweight U.S. equities, but where is really important. So we are talking about some of the large caps and the quality parts of the market. We've obviously, as you pointed out, Josh, correctly, there's been a wall of worries. But I think anyone that's expecting a recession, I think it's a little bit that fear of recession at this juncture is a little bit too early. We just haven't seen that in the data that we've gotten so far. So yes, a slowdown, but yet we have to remember where the strength still is underpinning in the economy. And this is a services economy that is still growing at a little bit lower than 2%, but nowhere near the zero. So for now, quality parts of the market, we're telling investors to stay to tickers like QUAL, which gives you that sector neutral approach to quality companies that have that strong cash flow.
We have talked to a lot of investors right now who, are looking globally on a relative basis and saying, okay, the US might be fine, but Europe maybe has more upside down. We've already seen that, catch a bid. China might have more upside right now. How are you thinking about some of those
Absolutely.
issues?
So that's been the big story of this year. I mean, outside of the pullback that we've had this month, the big story has been the outperformance of the rest of the world. And this is why, frankly, we tell investors to build this diversified portfolio. Even when we wrote our year ahead outlook, which came out in January, we talked a lot about this exceptionalism in the US, which doesn't just mean US stocks. stocks. It just means focusing on the AI story. It means focusing on earnings growth, which of course is still, even to this day, coming largely from large cap US, but looking at corners of, again, international quality, international dividend, and doing so, especially now, given the rally that we've seen, with active management, really looking at those stock pickers that can look at certain parts of defensives in Germany and so on.
We got that CPI print this morning, right? Cooler than expected. I think investors sort of breathed kind of a collective sigh of relief there.
Yeah.
What did you make of that print, and what do you think the Fed made of it?
Yeah, so a couple of things that I was thinking about. The first one was just a reassurance for the market that January was a one-off, that this wasn't a reacceleration of inflation. The second thing that I took away was, especially as it pertains to the Fed, they've talked a lot about that core X shelter component or core services X housing component. And that softened from a very strong print in January to a 0.2 in February. And I think they'll be very reassured by that. Also, when we look at just the services component, that's coming down to a trend like 0.3 as opposed to the 0.5. So a couple of things there that I think the Fed and investors alike are going to be quite happy about. But I do still want to caution that inflation is still sticky. We're still at core 3.1%, headline 2.8. This is still a very sticky inflation regime. And we're telling investors, actually, inflation-linked bonds, especially in the front end of the curve, something like an STIP that gives you that very front-end real rate exposure, makes a lot of sense in your portfolios for the next couple of months.
Gargi, it's very interesting, the disconnect. We've been talking to a lot of strategists who say, stay calm in this environment. It doesn't feel calm when you look at the market. Now, on a day like today, fine, but even on a day like today, there's a lot of volatility. It doesn't feel calm when you watch the tariff headlines. So how do you talk to clients and square that?
Julie, you're so right. It's one thing to be able to sit and say, stay calm, but it's quite different when you see a 10% drawdown. So what I am telling clients, and we're having a lot of these conversations right now, is this isn't a time to run to cash. This is a time to think about adding diversifiers and hedges. And there is a difference. Don't leave the market, don't sell the low. I mean, obviously, if everyone could always pick the low, we'd all be billionaires by now. But really add some hedges. And what might those hedges be? Think about assets that have been a little bit uncorrelated. So thinking about things like gold, that has been a wonderful hedge in portfolios. Thinking about just income-generating products, that are getting you 6.5% income in a portfolio. Things like adding to some inflation-protected bonds that we just talked about. Illiquid alternatives, another way in which you can sort of look at long-short positions, that you're just looking at alpha generation instead of market beta. So really, and then we talked about international as well, looking at quality at the center of a portfolio. So add hedges. Don't run to cash. And I want to re-underwrite the idea that we're not really worried about a recession yet. So if there was a concern around recession, I think the conversation that we would be having would be a little bit different. Right now, I think this is just a pullback from some of the price to perfection that we had in the beginning of the year coming into this year. And this is a healthy pullback.
The dollar has been weakening. I'm just curious, final question. How should investors be thinking through that dynamic?
Yeah, look, mostly in the U.S. investors have a lot of home bias. I think now with the recent weakening of the dollar, I think one of the things to think about is what does that mean for your non-U.S. exposures? Most people will have that hedge in, like a hedged position. So it's to think about whether you want a hedged versus non-hedged position. That's one thing that clients are asking about. So should I be hedging my positions back to the US dollar, or should I not be? So that's one thing to think about. And I think we can possibly continue to see sort of a range bound to a weaker dollar here. That's number one. And number two, it actually brings about quite exciting opportunities in EM, perhaps. To the extent that a stronger dollar historically has been pretty bad for certain corners of the EM market. I think now, especially with rates pulling back a little bit, I think corners of EM, again, looking at active management, and corners of EM can be exciting again.
I'm going to sneak in one more, actually.
Please do.
When we talk about not being worried about a recession right now, given the volatility that we've seen in the market, how worried are you about the possibility that we might not see a tax cut extension from Congress? And what would that do? Is that even a possibility that you're considering?
I think that that's not a possibility that the market's thinking about right now. I think the sequencing of when you got headlines around tariffs and immigrations, and obviously that came first, and the market still expects that there's going to be the tailwind coming from tax cuts later. I do think if that's something that at some point is completely discounted out, we probably could see some further volatility. I do think this is, again, coming back to my point of adding hedges, adding diversifiers. This year is not going to be the 2024 year where you just have that one straight line up, macro narrative, the Fed is easing and growth is strong. This is going to be a lot of little micro stories that are going to add volatility. And I think that's where active management and adding all of these hedges really makes sense in a portfolio.
Gargi, it's great to see you in person,
to be here.
especially. Thanks so much for coming in.
Absolutely,
Appreciate
thank
it.
you.
All right, we got to get some earnings now. We got Adobe numbers just coming out here. The shares are down a bit here, even though the numbers last quarter looked pretty good. The outlook perhaps not quite as strong here. So the company coming out here with first quarter revenue at about $5.71 billion. That looks to be better than analysts had anticipated. Earnings per share also beating $5.08, $4.97 is what analysts had anticipated. But the second quarter revenue outlook here, $5.77 billion to $5.82 billion. The average analyst estimate was 5.8. That seems to be in the middle. But still, it looks like maybe that's not good enough vis-a-vis what some were expecting, Josh.
Yeah, I mean, heading into this print too, Julie, it was already not great for Adobe. The stock was basically flat in 2025, was down nearly 25% over the past 12 months. I mean, analysts who follow Adobe will be quick to emphasize that's really AI disruption fears, in their opinion. That's what's really front and center been pressuring this name. Shantanu Narayan, the CEO, talking about how Adobe's success for the next decade, he says here, will be driven by customer-focused innovation. He talks about new offerings for creators, marketing professionals, business professionals, and consumers. Goes on to say Adobe is well positioned to capitalize on the acceleration of the creative economy driven by AI. Says we're reaffirming our 2025 financial targets. So trying to sound a note clearly of optimism here, but at least initially stock's down almost 3%.
Yeah, one more other thing I would just want to highlight that might be a reason why the stock is seeing some weakness here. It's the remaining performance obligation number for the first quarter. That's a measure of billings here, $19.69 billion versus the $19.8 billion that analysts were anticipating, potentially another thing that is sending the stock down. But let's get more perspective on this. For more on Adobe's first quarter, let's get to Alex Zukin. He is Wolfe Research Managing Director and Head of Software Research. So Alex, just give us, first of all, your first blush reaction to what we have heard from Adobe.
Yeah, look, I mean, I think that the numbers are fine, right? I think that they exceeded, their target on a core metric called net new digital media ARR, and it looks like they reaffirmed for the year. So I think the first blush is, they're doing what they need to do. They'll talk a lot, presumably on the earnings call, about some of the newer initiatives that they're going to be focused on, like Gen Studio, how AI could be a boost for the company over the course of the year. I assume that they'll comment on the demand environment, the competitive environment. But I would say, folks should remember Adobe has a penchant for being conservative on their guidance. And I don't think that that's any different. And look, the macro is changing. At least the headlines would suggest so in real time. So it's going to be really interesting to see how they address that.
Alex, I'm curious to get your take on what you think sort of distinguishes Adobe and its tools in the AI market. What makes them different, Alex? What's their competitive advantage here?
Yeah, I think it's two things. I think number one, they're the only company that's going to really indemnify you as a large enterprise when you're using their AI tools. And that is really important for large global institutions that are, kind of dipping their toes into generative AI for content creation. And the second thing is they're one of the only companies that has both the content creation side of the business with Creative Cloud and the content distribution side of the business from a marketing cloud perspective with their digital experience product. And this notion that they're going to, I think, increasingly talk about this year of one Adobe, not two different pieces of the puzzle, but really one cohesive unit that can benefit and have a virtuous cycle for customers that are adapting and adopting both technologies. That's just very different and differentiated. I think it's still a work in progress getting all those pieces to fit together, but I think generative AI is going to help them there.
So it's interesting, Alex, so it sounds like you clearly think they have a moat and they have this value proposition. The market, however, is obviously not convinced. We've not seen the stock perform. What do you think that Adobe needs to communicate out there, or what numbers do you think that people need to see to sort of change minds here?
I think it's pretty clear that Adobe needs to communicate a message of how AI is helping drive growth. And what's the metric that they can point to where they're seeing that growth come through without necessarily seeing a headwind to earnings or the investments that they're making to drive that. I really think that this is now year, I think almost 2 or 3, where we're trying to figure out where is the evidence and what does a Adobe plus AI functionality, both in the core creative side of the house, but also on the marketing side of the house, what does that look like? I think to the extent that they can do that with metrics around adoption, metrics around monetization, metrics around usage, metrics around upsell, cross-sell, TAM expansion, that's going to help investors get confidence that Adobe is an AI winner.
I've seen, Alex, some of your colleagues on the street and they're Adobe bulls. And really, I think one central argument they kind of pound the table on is they really believe 2025 is going to be when you see this kind of broader, AI monetization across the application layer. And their point being they really believe Adobe's position there to win and to be an early leader. Do you share that confidence?
I share the confidence on the thesis of that taking place. I'm a little bit more increasingly nervous that it's going to happen in a big way in 2025. I think if it does, it's going to be in the second half or maybe even the last quarter. And that's not just for Adobe. I think that's for a lot of my enterprise software coverage. So I am a big believer and bull that AI is going to be really good for a number of the enterprise software vendors, and that incumbents are going to have a really unique position and story to tell where their growth rates will be enhanced, their customer retention metrics will be enhanced, the utilization of their software will be higher. I believe all that to be true. I just don't think that it's yet.
And certainly the stock Adobe is not alone within software, right? Especially this year, we've seen many of these companies get caught in the same downdraft that we have seen for the largest cap tech companies. Some of the broader concerns that we've been talking a lot about lately, Alex, when it comes to tariffs, when it comes to growth concerns, do you think there are any implications for software companies as a result of all of this?
I certainly think that there could be, but I would remind folks that enterprise software as a sector is usually more resilient because these are large enterprise budgets that are set in advance, and it takes something large and sudden to change those budgets. I do think that typically during times of macroeconomic uncertainty, it can lead to certain projects taking longer, delays, reprioritization, maybe reallocation of resources. But I think it's going to depend on how sudden, how large, and how impactful, depending on the verticals that these macroeconomic headlines really fall onto. I would say right now, it's certainly we're seeing a locus of disruption in the federal vertical with all the headlines around DOGE. And so that's something that we're monitoring as a near-term impact for our coverage. But outside of that, I do think that there's a little bit more resiliency, redundancy, and buffer ultimately built in because of just how long it takes these things to move.
Alex, thanks as always for that instant analysis and insight, my friend. Appreciate it.
Good to have you. Good to see you guys.
Stick around. Much more Market Domination Overtime still to come. There's been a ton of back and forth and lots of confusion when it comes to President Trump's tariffs, but what's actually been enacted? Well, joining us now is Yahoo Finance's Ben Werschel. Ben, walk us through it.
For sure. Hey, it's good to be with you, Josh. So I feel like I'm on with you guys every afternoon to try and make sense of the kind of the herky-jerky day, and it's a little bit quieter on the trade front today. So as you said, mentioned, I wanted to kind of lay out exactly what's real. Even though we've seen sort of so much get backtracked, there's a lot that Trump's been enacted that has been real. And the bottom line from a lot of experts is that it's actually about 2 times Trump's entire first term in terms of the economic impact. So there's three tariffs main tariffs that have actually been implemented. They're in effect. The first one is 20% duties on China. This is one of Trump's first actions, and then he doubled it last week. That's on top of Trump 1.0 and Biden era tariffs. So that actually gets the tariffs on China in an aggregate. Some goods are higher and some goods are lower to about 30%, which I note is about halfway to Trump's promise of 60% tariffs on China. So those are real tariffs on China. Second is 25% duties on Canada and Mexico. Even with a backtrack last week on sort of all duties, this is still a significant tariff that's in place. It's around $450 billion in imports, according to an estimate by the Tax Foundation. And then the third came into effect today, which is 25% tariffs on steel and aluminum. And even though Trump floated for about 8 hours 50% tariffs on Canadian steel and aluminum and backtrack on that, the 25% still went in across the board, and there's large effects there. So the Tax Foundation has done the hard work on this, and this is a lot of these numbers that come in. They estimate that Trump's 2018-2019 tariffs, basically his entire first term, reduced the long-run GDP by 0.2 percentage points. This time around, if he does nothing else, he just sort of leaves everything he's done in place, we're talking 0.4% in terms of long-run GDP. So in the neighborhood of twice as much, and that works out to over 300,000 jobs less because of these tariffs, according to their estimate. And this is emblematic of a couple kind of larger themes of Trump, is that he is shown again and again, even as the markets question how serious he is serious about tariffs, and he has kind of an end goal here of big tariffs with significant revenues that are significant for the federal budget, which it currently makes up about 2%. And then the second point here is that even as the day-to-day is incredibly jerky, he wants to kind of reorient the trading system, and sort of the chaos is a little bit of the point here. So even though, I'm sure I'll be back tomorrow to talk about sort of whatever the threat of the day is and where it went away, at the end of the day, he is implementing significant tariffs so far.
Well, and Ben, as you wrote, whereas Trump in his first term was sort of famously fixated on the stock market as sort of grading him, he doesn't seem to care about a grade this time.
Right,
he cares
exactly,
more about these tariffs. And I think that what market participants are struggling to perhaps see through, even as we have the uncertainty day in and day out, is what he is trying to achieve sort of holistically with these tariffs.
Yeah, for sure. I mean, the way I try to kind of characterize in the story today is that it's not that he doesn't care about markets. I think he still does to a certain extent. It's just he cares about tariffs so much more this time, especially he cared a lot about tariffs the first term, but he cares about them even more this time. And it's that he really has this vision of these going into effect. The way he phrased it today was, we're going to take back a lot of what was stolen from the U.S. So that's his viewpoint, and he wants these tariffs to be big and in place to do that. And it's led to this idea that there's kind of going to be short-term pain that he's proven more willing to accept than markets thought, that in his view at least will get us to long-term gain in terms of a more fair trading system and a closer to a balanced budget on the U.S.
All right, Ben, great to see you. Thank you.
Sure thing. Talk to you later.
Time now for what to watch Thursday, March 13th. We're going to start off on the earnings front. We're going to be getting more reports from some names in the retail space, including Dollar General and Ulta Beauty. Dollar General announcing results for the fourth quarter in the morning. Analysts expecting same-store sales to slow as consumers continue to moderate spending on discretionary items.
More inflation data on the way. The Producer Price Index for February coming out in the morning. Economists forecast that headline PPI will slow to 0.3%, while core PPI could hold steady at 0.3% as well. All the new data this week giving us more insight on inflation ahead of next week's interest rate decision from the Fed.
And moving over to housing, weekly mortgage rate data from Freddie Mac is coming out in the afternoon. Rates have been on the decline, dropping 7 weeks in a row dating back to January. Current rate on the 30-year fixed sitting at 6.63%.
And finally, Commerce Secretary Howard Lutnick and Ontario Premier Doug Ford scheduled to meet tomorrow in Washington, D.C. The meeting is to discuss updates to the United States-Mexico-Canada agreement. This all following a series of recent trade tensions between the U.S. and Canada. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour with with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned.